Ladies and gentlemen, thank you. The silent movie continues. We'll see what comes out of the mouth when I open it, see how that goes. Arantxa, thank you. I was saying to Arantxa that the way this is going to be, it's going to be one of those sort of thoughtful interrogations where I don't say very much, but I look at you with a sort of penetrating look, and then you'll reveal everything. That's the plan. This is one of those brilliant sessions which is blandly titled, but is actually about the weaponization of all the most important areas of economics: trade, assets, and currencies. And our aim is, in the course of this conversation, with Greg Baer, who obviously worked at the Treasury and the Fed and now runs the Banking Policy Institute, Josh Lipsky, who worked in the Obama administration, then in the IMF, and now runs international economics at the Atlantic Council, and built this geoeconomics unit around these issues, Josh, so I understand it. And Arantxa González-Laya, who you really don't need me to introduce to you to the former foreign minister, and of course now leading the thinking on particularly this issue. I'm going to start with you, Arantxa, if I can, because Europe has had quite a kicking this morning, and it would be easy to come away from this morning's conversation thinking America's got it right and Europe has got it wrong.
All right, so let me just take you in the opposite direction.
Okay.
At least in the topic that we are discussing today, but it's emblematic of what's happening in the US. When we look at the US, we see a roaring economy, and it's a roaring economy. So I don't think that the US has an economic problem. If I take 1990 to today, the size of the US economy has doubled. The wealth of the 1% of America has doubled. The wealth of the bottom 50% of America has stagnated.
Yeah.
So the US does not have an economic problem. The US does not have a trade problem. The US has an inequalities problem. And inequality today is a political economy problem. It's easier to deal with this inequality problem, to deflect the attention, to push this conversation into the direction of the rest of the world is taking advantage of the US, which I don't think it is.
No.
Or to try and apply a cure that does not necessitate to go through the tough sludge of going through Congress, meaning executive orders. And this is a lot of what we are seeing today. We are not seeing the source of the problem reducing. Actually, if the goal of this exercise was to reduce the American trade deficit, which I don't think it's a particular problem, but okay, let's imagine it was. The trade deficit is exactly where it was. If the goal was to increase manufacturing jobs in the US, never mind that in the last 30 years they've been reduced everywhere around the world, including in the US, well, guess what? It's not increasing. If the problem was about reducing imports, yeah, but guess what? We're also seeing reduced exports. And that's a problem. So we don't have the cure to the real problem, and we've, in the meantime, imbalanced a host of other issues, including, by the way, and I'll end here, giving an advantage to China over Switzerland, India, or even Vietnam today. Yeah. So tell me.
So actually, that's a perfect note to turn to you, Josh. I want to come to the impacts of trade policy on growth overall. Yeah. But I think for a lot of us, we look at the Trump administration and it's like understanding a teenager. The reality is the teenager changes, right? And we don't know which one we've got. So just on trade policy, what is the Trump position on trade now? How's it developed even in the course of this year? And where do you think it goes?
Yeah, well, this is the fundamental question, and I really believe that he organizes his worldview and his second term around trade policy. And I often say with the second Trump administration, it's useful not to think of this as a second term of a presidency, which is usually a continuation of the first term policies, but instead a new presidency completely. And if you compare the second term to the first term, I think you see that across a range of issues. We said at the Atlantic Council a year ago, right after the election, he was going to launch a trade war unlike anything seen in the first term, and I think that's borne out. And the reason we said that is because Trump has three fundamental ways of thinking about tariffs as a tool, and you outlined some of them. Of course, one is negotiation, and we see him use that. He's using it, just used it with China last week. The second is the true macroeconomic use of a tariff. That can be reshoring domestic manufacturing, which is not going to happen for all the reasons you outlined, or revenue raising, which is happening, and this is a critical part of the Trump administration strategy. The third, and this is misunderstood about the Trump administration, is tariff as punishment. Tariff is a form of sanction, as I know Greg will talk about. So this is moving away from financial sanctions into the tool of tariff. And if you look at what he's doing with Brazil, for example, that's not macroeconomics and that's not really negotiation. That's tariff as sanction or tariff as punishment. And if you think about it, they actually have a strategic view. And in any particular case, they apply a different tariff in a different scenario. It doesn't perfectly work, but it's a construct. What's so critical right now is that tomorrow, the core of his trade policy is going to be challenged in front of the Supreme Court.
Yeah.
So he has relied on something called the International Emergency Economic Powers Act to levy 2/3 of the tariffs in the second term, estimated revenue around 150 to 170 billion, depending on how you think of the exemptions. The Supreme Court will hear argument tomorrow whether that was constitutional or not, and it's unclear how they will come out. A lot of people think the court's just going to defer to the president, but as all lawyers in the United States know, the famous line is, Congress does not put elephants in mouse holes, which means that if Congress wanted to delegate its constitutional authority to tariff and tax to the president, it probably would have put the word tariff in the law he's using to levy these tariffs. So this is what tomorrow is going to be about. And the reason I raise that is because it could potentially undercut the structure I just outlined. So nothing is certain going forward.
But Josh, can you just talk about what the impact has been on growth? I suppose, if we'd had to bet a year ago on what this trade war would do to the economy, the views of people on this stage would have been catastrophic.
Yeah.
And it's not clear that it has been catastrophic.
No, certainly not. And I think everyone has to go back to their priors about tariffs' impacts on inflation. Now, part of it, and I think Europe plays a big role here, is that countries did not retaliate. Right? So a lot of these inflation estimates and the growth estimates, what the IMF was saying 6 months ago, right after Liberation Day, was on the presumption that there would be trade wars, which by and large, outside of China in the spring and summer, didn't materialize. My view of that, everyone wants to blame Trump about starting and resetting the global trading system. I think other countries also had problems with this global trading system. You cannot smash through a system built over 80 years if it's not already brittle. So Trump might have been the catalyst that smashed through it, but that system had grown brittle for decades through all of our faults and not addressing the core problems. But I think this is part of the reason you haven't seen the more dire economic forecast.
And of course, the most common forecast from economists was it would clog up the global trading system, it would destroy growth, but even for Americans, it would be bad news because it would be so inflationary. And so far, economists are saying, either economists are saying we got it wrong, or they're saying we're not right yet. Which camp are you in?
Look, I'm in the camp is that it hasn't materialized as much as many expected, and it probably won't, even though it will have a marginal impact on inflation. But the bond market issue is significant. If you think about what happened in the bond markets after Liberation Day, they panicked. They caused the president to retreat on some of the Liberation Day tariffs. But step back for a second. When Trump came into office, the effective tariff rate in the United States was 2.5%. What is it today? 16%. The Liberation Day rate was 17%, and it's only going to go higher when we get semiconductors, maybe pharmaceuticals coming. So just to put this in perspective, the world's largest economy over 9 months has shifted into an extraordinarily protectionist position, and it's not going back. I talk to a lot of people about this in Washington. People say, oh, after Trump. No. A Democrat, if he or she wins in 2028, is not going to lower the tariffs back to 2.5% politically and because of the bond markets, because now the bond markets are relying on this revenue projection, 2.5 trillion, 3 trillion over 10 years. So I just raised that in this room, in this group, to say we have reset global trade in a short amount of time, and now we live in a much more protectionist world from the US, and of course then retaliatory protections around the world.
I'd like to, what I'm going to try and do is do trade and tariffs and then come, if we can, to sanctions and then to currencies. So Greg and Arantxa, can we just talk about that? If Josh is right, and I suspect a lot of people in Washington would say he is right, this is not just personal, this is not just the policies of Donald Trump. This is a fundamental historic shift in the way in which the US sees free trade. What happens next?
Well, I mean, I think Josh has it right. I don't think much is going to change, even if there's a Democratic administration. A lot of this goes back to the decision made, I think, in 1992 to admit China into the World Trade Organization, which I think everyone now recognizes was a mistake, at least in the United States, and I think that's probably bipartisan. Also, I think, as you alluded to earlier, this is now a substantial source of revenue. So if you're going to eliminate tariffs, you're going to need to raise taxes by $200 billion a year or something like that. It's interesting, even when Trump ran the first time, the only thing on which he and Hillary Clinton agreed was that we should not participate in the Trans-Pacific Partnership, which was sort of a remarkable thing at the time. So, there are not many things that are bipartisan in Washington. I think number one is deep antipathy towards China. And I think the other is deep skepticism about trade.
And then Arantxa, I suppose if you take Josh's point that so far the rest of the world hasn't retaliated, they've thought this is a rush of blood to the head, it'll pass. If it's not, if the United States has a more protectionist approach to trade, then sooner or later that's going to be Europe's approach, that's going to be India's approach, that obviously is going to be China's approach. What does that do to growth?
Well, this is not what we're seeing. And this is why I don't think it's a reset of the international trading system or the international trading order. What we're seeing is a bifurcation. The US has decided to increase the protection it applies to third country imports by about 15–16%, although we shall see where this lands, because we keep seeing exceptions as industries lobby the government because they need to have access to inputs in order to export, and they're losing export markets, and they don't like that. So imagine that this is like an energy shock that is only applicable to the US. The rest of the world is moving forward. I don't see a reduction in the appetite for opening markets in the rest of the world.
So can I ask you then, if you were back sitting around the table at the European Commission, or you're here in Madrid, and someone says to you, what's our best bet in trading terms for the next 25 years, China or the United States? What do you say?
What I say is there is China, there is the US, and there is a whole world, very nuanced, around that too. So the first thing I would say, if I'm a European, is to say my trade might depends on my capacity to deter my enemies. So let's be clear, we have to invest in our security and in our defense, because otherwise our trade might is smaller, number one. Number two, I double down on opening markets with lots of partners around the world. And by the way, these partners are flocking at the door of the European Union. Whether you're the Emirates, whether you're India, whether you're ASEAN countries, whether you're Australia, they are flocking to knock at the EU's door. So that's my second strategy for Europe. The third one would be double down on integrating the European Union's single market.
Yep.
Because that can be a very helpful shock absorber for when China and the US, or the US or China, go crazy. 1% reduction in exports to the US can be compensated by a 0.1% deepening of the European market.
But can I just move on, if we might, just to sanctions as an example of the European versus US policy problem. So Josh is saying the Trump administration is in front of the Supreme Court tomorrow over whether or not its trade policy is legal. And last week, the European Union couldn't agree a sanctions policy on Russia, which was consensual, right? the culture of politics is so different. We want to get 27 countries all to agree. They don't even care whether or not they're operating according to the rules of the Constitution.
Yeah, I mean, look, the European game is very simple. There's been 19 packages of sanctions on Russia so far, hey? So let's not do as if.
Okay, fair enough.
19, and in these 19 times, there has always been one that has taken a lot of airspace, that has taken a lot of your airspace in the media, that the Europeans have had to be very patient with, and that the rest of the 27 member states have had to buy, quote unquote, with a bit of a candy. But the 19 packages of sanctions are there. So let's it's difficult in Europe because it's not one, it's 27, but let's also not pretend that Europe is not adopting packages of sanctions.
So Josh, what do you think of this? What do you think of Europe's approach on sanctions, and for that matter, the US?
Yeah, well, it's very interesting when you think about what's happened, sanctions, and how we got to this G7 coordination post-Russia's invasion of Ukraine, because the arc of this post-9/11, the escalation of sanctions use in the United States, sanctions is a complementary tool to kinetic military action. That's really the standing up of terrorism and financial intelligence and treasury. The kinetic leads, but the terrorism and financial intelligence, the sanctions can choke off finances to al-Qaeda. Then you get to Iran 10 years later, and it's sort of the threat of kinetic military action, and then the sanctions in the background to leverage. And then you get to Russia's invasion of Ukraine, where the G7 response is not direct military intervention, but leading with the financial sanctions.
Yeah.
And you have the coordination, US and Europe, that it was the heart of making those sanctions work. And Putin's bet didn't pay off, because after the annexation of Crimea, he diversified into euros, thinking that the G7 couldn't align on a sanctions regime should it come to it. And the G7 proved him wrong. I think effectively so, and I think surprisingly so, and I think Xi Jinping took note of that as well. Now we're in a very different world where it's much harder to coordinate on sanctions because of divisions between the Trump administration and Europe over trade. So the tools of economic statecraft play out because we're having this dispute over trade. It makes it harder to coordinate on sanctions. We look at the Russian asset seizing and freezing situation. So now the G7 coordination, which I think is such an effective tool of economic statecraft, is under question going forward. And the real challenge is about de-dollarization. Why is the Trump administration saying they're moving away from financial sanctions? He believes that it leads to de-dollarization, and I'll point you to a speech at the New York Economic Club during the campaign. Now, we can debate whether that's true or not. I think there's data that shows the opposite, but the point is he believes it, and he's focused on BRICS countries and de-dollarization and the building of alternative payment systems. This is a big issue for this administration. So we have a fractionalization on the sanctions regime compared to what we had before.
I'm sorry, I don't understand that. Why would sanctions, I mean, we're about to start talking about stablecoin and re-dollarization. Why does he think sanctions lead to de-dollarization at scale?
Well, this is something that has been debated for years, but certainly accelerated after the G7 froze Russia's sovereign assets and then debated seizing the assets, as we all know. Could this lead to countries looking for alternatives outside the dollar, outside the euro? Now, I think the evidence and the data hasn't shown that yet, but I think the Trump administration, there are people within the Trump administration who are concerned about that risk.
Yeah, I mean, I think there are a couple of things at play with sanctions. I mean, the first is efficacy. The greatest beneficiary, I think, of the sanctions has been China, and to some extent India, which is buying a lot more oil than they used to from Russia. So that's not necessarily a great result if you basically guarantee China a lot of oil for cheap and basically make Russia a de facto vassal state of China. So that's not a great outcome. But yeah, there's always been concern, and I think actually one of the stated motivations for the digital euro has been concern about sanctions. So I think it's well known that in Europe, 80% of transactions are processed on Visa, MasterCard rails. People ask, well, what if he sanctioned us? And so I mean, I think that's probably an overstated concern, but it's not a crazy concern. So I think for all those reasons, there's some pulling back on sanctions. And then the thought, I think, is that tariffs are sort of the same thing. We've talked a lot about Clausewitz today, and between kinetic warfare and diplomacy, there used to be no middle ground. And now you used to have sanctions. Well, in the old days, it was blockades. Now it's economic sanctions. And now you throw tariffs in, which, it's an interesting debate. Are they more nimble, more targeted? Do they have fewer sort of ancillary consequences for the status of the dollar? You don't think about people de-dollarizing because of tariffs as much as sanctions. So it's a very complicated sort of economic warfare debate that's going on.
So can we pause on trade tariffs and sanctions and just talk for a bit about currencies? When Anna was talking earlier with the governor of the Bank of Spain, actually it was really striking to me how positive and enthusiastic he was about stablecoins. I mean, they are going to have a big impact on the financial system, and it feels to me as though your sort of cryptos and your bitcoins are wildly over-reported, and stablecoins as an issue and a change to the financial system are probably quite wildly underreported. So Greg, where do you think we are? How much is the financial system already changed, and how much change is coming?
Well, on stablecoins, I think you have to think about it first retail versus wholesale, and then US, EU versus developed countries. So retail in the United States, for example, if you want to make a payment, you can use your credit card, you get rewards, you get float, and you get the right to charge back if there's any problem. Those are pretty hard to substitute for with a stablecoin. Maybe you can create some ecosystem where you're getting enough rewards from your stablecoin that you're willing to give up all three of those things. But I always think about it as use case and pulling out your wallet, and why would I transfer money out of my deposit account, or why would I not use my card and instead put that into a stablecoin to make a purchase? So I think that's very difficult. On the other hand, and this gets to our other topic, if you think about a stablecoin not as a means of exchange, but as a store of value in the classic definition of money, if you're outside the United States in a country that has hyperinflation, potential capital controls, you don't care that that stablecoin doesn't pay you interest.
Yeah.
You're happy if it just stays at $1.
Yeah.
And so I think that's what Secretary Bessent has talked about, which is we view this as a means to get more and more money into treasury bills, and not incidentally, although he never mentions it, into bank deposits, because a lot of these stablecoin issuers also hold US bank deposits. So that's sort of retail. The wholesale, I think, is much more complicated and much more interesting, because the question is, as more and more commerce moves on-chain, and you want atomic settlement of transactions, potentially in very large amounts on-chain, and including security settlement, how are you going to effectuate the payment leg of that? Herstatt risk is now back to being a discussion item. That was a generation ago. We created the continuous link settlement system so that there would be no offsetting, there would be no problem with time zones, and you wouldn't have a fail on one end of the transaction. So what's that going to look like with on-chain commerce and payments? I think, as was talked about earlier, there's a lot of work being done by banks on tokenized deposits. There have recently been some pilots and even actual transactions going on where there were atomic settlement with a tokenized deposit against a treasury. I think there's a project certainly in Hong Kong, I think in London as well. And then the question is, well, what's the stablecoin's role in that? I mean, traditionally, stablecoins have grown up because they were 24/7. They became the currency of crypto trading, and I think in the case of Tether, not incidentally, money laundering and terrorist financing, but those were their use cases.
Yeah.
And so now the question is there a use case around settlement on chain? And I think if you're settling millions, billions of transactions, just as we saw money market mutual funds break the buck, in 2009 and then again in 2020, you've seen multiple depeggings of both Tether and Circle.
Yeah.
And are you going to build a wholesale payment system, security settlement system, on something that could depeg, and are people going to proceed with that?
So can we just talk about two structural things in that context? Firstly, the dollar and the power of the dollar globally, because on your store of value argument, if you're seeing essentially individual account holders globally picking up stable coins, that is a challenge for the governor of the Bank of Spain. You are going to see a new power in the dollar and use of the dollar globally at a retail level, aren't you, Greg?
Yeah, I mean, it's a fun fact. I mean, right now, if you think about US paper currency, more than 50% of it is held outside the United States. And it's under mattresses and in safe deposit boxes around the world. And that has not really been a problem for a lot of countries because it's actually hard to get your hands on that much physical cash. It's one reason the US, I think since the 70s, has not allowed the creation of a bill larger than $100 because they want to make it hard and dangerous to transport large amounts of cash.
Right, yeah.
So you've never been able, if you were in a destabilized country somewhere, to get your hands on lots of physical cash.
Yeah.
But now if you can go to Binance and buy a US dollar-backed stablecoin, you can get that security quite easily. And I think some would view that as a bug, and I think some, including the Treasury Secretary, would view that as a feature.
Yeah, just to add on that, I think what we're seeing is a bit of a backlash to that dollar stablecoin policy around the world, especially in EMs, right? Because they're worried about monetary sovereignty. They're worried about what I would call digital dollarization of their economies. Dollarization, nothing new, but now you have it on steroids. Now, I think the administration's view of that is if people around the world want dollars and they have easier access to dollars, so be it. But I think you see a lot of central bankers and finance ministers around the world thinking about what kind of guardrails do they put up. And back to where we started the conversation with Anna this morning, to us, when we think about the geopolitics of this, it's about the rails. It's not just about the stable coins themselves or the CBDCs if they're digital euro. It's about how this transfers around the world and the network that that's built on. Is that going to be SWIFT and chips? Or is that going to be alternative payment systems around the world? And that ties back into the sanctions conversation. Because then it's the dollar as macroeconomic tool, but also the dollar as a means of national security.
So in a way, as weaponize the economy at your peril. You do it, others will do it to you too.
But can I just understand a second element on the stablecoin point? So it consolidates the power of the dollar. Does it also consolidate the power of the incumbent banking system?
Not necessarily. There can be many new players. You see this proliferating with stablecoins. Now, to the extent those stablecoin companies bank with the traditional banking system, and then those stablecoins end up having relationships with the Fed, or those banks do, you can see that being integrated from a US perspective in traditional finance. But that's far from clear that that's how this will end up.
No, I think most banks would see stablecoins as a threat to deposit funding.
Yeah.
I mean, it's the age-old pursuit of everyone wants to be able to issue money-like instruments, right? I mean, sovereigns like to issue them because they get seigniorage, they get interest-free loans from people. Banks issue, commercial bank money. They get to do that at very low deposit rates. And now stablecoins want to do that and be an alternative.
I'm only asking you, Greg, because it's counterintuitive. The worry about stablecoins has been exactly in the point that Anna made earlier about alternative banking systems, alternative financial systems. But if the adoption is quicker and more effective within the established banking sector, might it actually surprise people and consolidate the power of the banking system?
Yeah, I don't see it consolidating the power of the banking system. I don't think most banks do.
So let me finish up. We're out of time. I want to just end with one question. There was a fad, I would say, probably about 5-7 years ago, to have panel discussions like this, at which we would earnestly discuss the end of the American century, and that America as a global power was not what it was. We'd seen that happen militarily, economically. When you listen to the three of you, you would look at the next decade, and whether it was on trade and protectionism, whether it was on the power of the dollar, whether it was on technology and finance, you would say the United States holds the cards. Is that fair? Greg, why don't you go first?
I think it's fair. I mean, clearly, the dollar is, as a percentage of global central bank reserves, declining somewhat. I think it's still almost double the euro. Central banks are now holding gold. But you don't have to be great. You just have to be better than everyone else.
Right.
And it's sort of funny. If you think about all the hallmarks of why the dollar is stable, it's monetary policy, it's military might, it's the English language. It's kind of funny we're all speaking English here. I think all of those things sort of tend to correlate. So I think it's looking pretty good. That's not to say that there are others who don't have designs on being the hegemonic currency, but it's a tough road to hoe.
Josh?
I'll disagree slightly, only to say that, of course, there's no alternative to the dollar, but I think the US position can be overly reliant on that and look at everything China, Europe, the UK, Japan, and say we don't have anything to worry about. It's defensive. It's not innovative. It's not forward-leaning. And eventually what you get to is not a replacement of the dollar, but more multipolarity over time. And I think we are headed over there in the medium term.
The thing is not heart attack, it's cholesterol. You can die of heart attack, but you can also die of cholesterol. It just takes longer. if you don't watch out. I think in the US, two forces are pulling in two different directions, and at some point, either you reconcile these two forces, the force of the economy, the force of technology, the force of the integration that the US has built with the rest of the world for decades now, and politics that are pulling in the other direction. At some point, you either reconcile these two forces, or it just crashes.
Okay, well, the Europeans, we're going to have to take our statins, deal with our cholesterol problem. Ladies and gentlemen, please join me in thanking Greg Baer, Josh Lipsky, and Angela.